I never know what markets are going to do. I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I've never felt that I knew it, and I've never felt it was important. We're almost always a buyer of stocks, and we're a more aggressive buyer when they're going down. I mean, I feel much better when they're going down. I think every business should be run as efficiently as possible, and some are and some aren't. We try to buy the ones that are. I mean, I bought my first stock in April of 1942. I was 11. Pearl Harbor had happened 3 or 4 months earlier. We were losing the war. I mean, if you want to talk about a bad outlook for the country's not going to go away. The plants aren't going to go away. The people aren't going to go away. The talents aren't going to go away. The country will grow in value over time. Now, who gets it is another question. But
Warren Buffett believes that it is impossible to predict short-term market movements. However, he believes that the market has a tendency to rise in the long run. He actively buys stocks when the market is down because he believes it is an excellent opportunity to buy efficient companies at a discount. He focuses on the potential for long-term growth, even during challenging economic conditions, because he believes that countries and companies do not disappear, but rather increase in value over time. He suggests that investors should focus on long-term growth potential rather than short-term market movements.
Stocks, as you know, trading once again near record highs. Does the market appear overvalued? Should investors worry about a correction?
Well, you shouldn't worry about, if you worry about corrections, you shouldn't own stocks. I mean, if you can't take your stock going down, it's going to go down sometime if you own a stock, so why worry about it? I mean, the point is to buy something that you like at a price you like and then hold it for 20 years. And you should not look at it day to day.
Day to day.
If you bought a farm or apartment house, you wouldn't get a quote on it every day or every week or every month. So it's a terrible mistake to think of stocks as something that bob up and down, and that you should pay attention to those bobs up and down.
Bob up and down.
Your businesses encompass pretty much every part of the economy. What part of the economy do you think might outperform in the year ahead?
Encompassed.
I don't really know what will happen in the year ahead. I can tell you what's happening now, but we don't spend any time forecasting our business. We don't have a budget for that. Some of our companies do themselves, but we are not in the business of trying to predict what's going to happen next year. We just play the hand as well as we can as the year goes by.
One of your top stock holdings is IBM. It's been an underperformer. Do you wish that you bought Apple stock instead?
No. We bought, I mean, obviously you can look back and say any stock that went up a lot, you can say you wish you bought that stock, but we don't think that way. We buy businesses we think we understand at prices that we like, and then we hold them for a long time, and we usually make money, but not always.
You don't need to worry about whether the market is overvalued or if a correction is coming. Investors should have a long-term perspective, buying shares of companies they like at prices they're comfortable with, and holding them for 20 years. Stock prices fluctuate daily, so there's no need to check them every day.